Welcome to Explainable AI, where demystifying digital minds is your personal journey into the heart of artificial intelligence. I'm Paul Anthony Claxton. I'm an AI venture capitalist and serial entrepreneur. After a decade of service in the Marine Corps, I was captivated by the power of battlefield technologies, and that is what inspired me to dive into the world of enterprise technology and eventually AI. My commitment is ultimately to make the world a more meaningful place and a better place, which leads me into venture capital, where I view capital as a powerful tool to drive positive change. As a recognized thought leader in AI and venture capital, I regularly share my insights through podcasts such as this one or on articles that I write for various platforms such as ideascale.com and even the AI Accelerator Institute. You can learn more about me on paulclaxton.io, which is my personal professional website. I want to introduce you to my co-host, Rohan Hall, as well. Rohan.
Hey, thanks, Paul. Appreciate it. So, hi, everyone. I'm Rohan Hall. I'm an author and the co-host of Explainable AI. I am a serial entrepreneur and advocate for conscious entrepreneurship. I help businesses leverage AI for efficiency and growth, and I founded the Ninja CEO Foundation to bring AI education to underserved communities. I'm also excited to launch OCESHA, that's OCESHA, a new content creation, distribution, and monetization system designed to help entrepreneurs and agencies maximize their reach and generate revenue. To learn more or connect with me, visit rohanhall.com or ocesha.com, that's ocesha.com. Let's explore how AI and innovation can drive positive change in business and beyond.
Wonderful. And today we're welcomed by our guest, Rafe Furst. If you just take a moment to introduce yourself and tell us a little bit about your background and how you got to where you're at today.
Yeah, it's a real pleasure to be on with you both. Yeah, I actually started off in AI research in the early 90s, long before we saw the LLMs and the incredible power of the AI, the Gen AI that we're seeing today. So it's a very exciting time. I left academia when I found out about the web browser and the internet revolution, the Web 1.0 revolution. I just had to be a part of it. So I jumped in as an entrepreneur in the mid 90s in Silicon Valley, started a company with a couple of friends. We got really lucky, hit some good timing, had a nice little exit, which really propelled me along three parallel paths, one of which was serial entrepreneurship. I ended up co-founding four more companies before retiring. And then also angel investing and venture capital. And then also semi-professional poker player in the 2000s. All of these activities, for me, they're united in a similar way to my love and interest in AI, which is they're all about really strategic risk taking, making good decisions under conditions of high uncertainty, risk, and consequences. Paul, you may resonate when you're tours of duty with that. So I see the foundation that I got in school and around AI and doing research to be really helpful in all three endeavors. So that's a bit about my background.
That's a very interesting background.
Hey, it's Rohan Hall. Hey, what if I were to tell you that there are thousands of potential clients that are looking for your specific expertise right now? The problem is they can't find you. It's not a problem with your expertise, it's a problem with your discoverability. And this is what we're working on right now at OCESHA. If you'd like to learn more, just go to ocesha.ai. That's OCESHA.ai to learn more, and feel free to join our early access program. We're going to be launching this in April of this year, 2026. Thank you. And now back to the program.
One thing that really got me excited was your history as a poker playing champion. I believe you're a champion in that space. So with that being said, how do you view current and even potential future applications of AI? Do you think AI, being that there's this Jekyll and Hyde thing going on with AI, do you think it reduces the risk by having AI being so risky? Do you think it reduces the risk in things like investing and decision making and so forth, or do you think it increases our risk vulnerabilities?
Yeah, I think when we're talking about particular applications where human beings are in charge ultimately of making decisions, I find it a really empowering and powerful and risk reducing and value creating technology. And just to give an example, currently I'm about to publish a book called The Future of Venture Capital. And there's a whole chapter on AI and using AI in every aspect of your operations and decision-making process as a VC investor. And I see nothing but positives. In fact, I feel like those who are not embracing that technology are going to find themselves in a similar situation as professionals and companies did in the late 90s and early 2000s if they weren't embracing internet technology and finding ways that it can improve their performance and efficiency. I feel like and predict that venture capital investors will be left behind. So yeah, and we could talk about, of course, the Jekyll and Hyde, but it's really only, in my opinion, it's only when you're talking about societal scale decisions and then outsourcing agency and decisions to the AIs. You always, in my opinion, we always want humans making the ultimate decisions. We always want humans holding the culture and the values that we're wanting to promote in the world.
Yeah, I think you brought up some good points. Investing is a lot like probably gambling in many ways. I think
I like to call it strategic decision making.
Absolutely.
And here's the critical difference. Yeah, I call it gambling if you don't have a verifiable edge, right? If you're playing against a casino in a game like roulette,
Yeah.
the house has a very quantifiable edge against you. So to me, that's gambling. If
Okay.
you're playing poker and you're better than the average poker player that you're playing with, you have an edge. And so to me, that's strategic decision making. Now, when it comes to like venture investing, the risk and the volatility is super high, similar to playing poker. And it can be gambling if you're not managing your bankroll and you're managing your risk appropriately. But if you know the statistics and you know the odds and you know the volatility, you can actually create really great risk adjusted returns by having proper diversification and not over betting your bankroll. And to me, I like to make that distinction between gambling and strategic risk taking.
That makes a lot of sense. And I would say unsuccessful venture capitalists or investors are the gamblers of our industry. But I think being able to have enough insight to make those strategic decisions so that you're reducing that risk as much as you possibly can is a whole nother level. So like when it comes to implementing AI to help us do that, I think investing can be very linear, right? Just in terms of the industry as a whole, because all venture capital firms pretty much do the same thing, right? They pretty much have the same structure and the same deployment approach, et cetera, et cetera. I think the key is in the algorithms that venture capital firms or investors, private equity firms use. The proprietary algorithms in terms of helping them make those decisions is what's going to make them competitive. Would you agree, or what? Do you have any thoughts on that?
Yeah, I would say yes with a caveat. For me, the main signal in all the data, especially when we're talking about early stage venture investments and early stage companies, the main signal is not the technology or the idea or the timing or the market, total addressable market. A lot of these signals that folks key in on, to me, there's not a lot of signal there. It's too uncertain, too volatile, too hard to predict. But for me, what I look for is the qualities of founders and founding teams. And so I think we're going to start to see AI being used to identify and to do diligence on who are really the exceptional founders. And the reason I say that is that we can have a great idea, but the timing is off or something comes out of left field, something uncontrollable, unpredictable. But if you have a really good founder or founding team, they'll be able to navigate those uncertain waters and they'll be able to pivot. And there was a big meta-analysis done a decade or so ago, Startup Genome Project, and they found that successful companies, successful startups pivot from their original idea an average of, I think it was 1.7 times. If they were going to be successful, they pivoted on average 1.7 times before finding that product market fit and achieving scale. So as an investor, I think I'm investing in one idea or one technology or one product. And the reality is more than likely it'll be something totally different if it ends up being a successful investment. So that's why I think it's really important to focus on the quality and the character of the founders. And I think AI can really help with that.
Great insight. Rohan, do you have any thoughts?
Yeah, I'd like to follow up with that. Correct my numbers here, but I understand that VC investments are, I think it's an acceptable something like 80 or 90% failure. I don't, please correct me whatever those numbers are, but I think it's a pretty
Close
high
enough.
failure. Yeah,
Yeah.
okay. And VCs already have all the financial power and resources on the planet to get this right. And VC's concept is not new. And in those the 10% where they're successful, the other 90%, and I'm speaking more from an entrepreneur point of view, the VCs walk away with everything, right? And the entrepreneurs kind of nothing in many of those cases, right? This is really the reality of the stuff. And so what you're saying is that AI will somehow help with a greater success rate, which for me is fantastic if that's what the case is, because that means numbers will be better than 10% success, meaning that there'll be more entrepreneurs that will also be more successful. So how do you see AI helping with that? In what way do you see that it's not like VCs have had a lack of resources to be able to get it right? So now this is just another tool. So how do you see VCs can deploy this to have a greater success rate for themselves and therefore a greater success rate for investors that put all their hard-earned time and money and trust into these VCs with the expectation of success where 90% of the time is failure?
Yeah, there's a lot in there, and you bring up a really important point about mismatched incentives and how the VC investors can profit while actually not doing so great for either their portfolio companies or their limited partner investors. And so this is one of the big themes of my book, and what I tell people whenever I get the chance is that the traditional venture capital model is broken from the standpoint of it's not great for the entire ecosystem of venture capital and startup land. And so if we can improve the way VCs deploy capital, and I can tell you in a minute what I think that is based on the data, based on the numbers, based on analysis. If we can fix the venture ecosystem everybody's going to be better off. Maybe not the incumbent top VCs. They may not be able to have the monopoly that they do, but everybody in general will be better off. We want to see a higher success rate for entrepreneurs, whether they're venture backed or not. And we want to see better returns for limited partner investors who really are the ones who enable VCs to be able to do what they do. And at a broad level, here's what I think is broken or suboptimal in the venture capital industry and how we can fix it. Number one, it's a little known, it's a well-known, it's an open, dirty little secret in venture capital that over half of the individual funds actually lose money for their limited partner investors. And this is for a simple reason. It has nothing to do with how good a VC is at their job. It's just that there's so much inherent uncertainty, especially at the early stages, that in order to have good risk-adjusted returns and not risk underperforming the overall market, you have to be diversified quite a bit. So a typical VC fund, Paul, correct me if this doesn't jive, is a typical VC fund deploys to 25 or 30 companies over the course of a 3-year deployment period. All the numbers show that's about 10% of the diversification you need. In order to harvest this, what we call a risk premium in early stage, but not have a risk of underperforming the market, you need to have about 300 deals in your 3-year portfolio, or I like to say 100 new deals per year, 100 new early stage deals. If you do that, historically, you would achieve a staggering 25% plus rate of return, annualized rate of return, which is got to be one of the best asset classes of all time. But the key is, if you don't want to be gambling, then you need to be more diversified. To me, this is good news. What it means is that as a limited partner investor, there's more opportunity to deploy capital, and there's more opportunity to diversify across different venture capital managers. But there's also an opportunity to invest directly and do so with these numbers in mind and what the correct strategy is. If you really want to play what we call game theory optimal in poker, there's a strategy that it's not really beatable called game theory optimal. I believe there's a similar strategy for venture capital, and it's a massive diversification. Stick to the early stages. Don't do follow-on investing, which is the more standard in venture capital, is to do follow-on investing. That's a controversial claim, and we can talk about that if you want, but those are my thoughts on the way the industry is going. And I think it's good news for founders, it's good news for LP investors, and it's good news for emerging VC managers.
What's wrong with follow-on investment?
There's nothing wrong with follow-on investment, but it goes to opportunity cost. So the later stages of the investment, they come naturally with lower risk, but lower returns. Okay. So if I'm looking to actually have the best native returns, and I have $1 to invest, and I could invest in an earlier stage company that's new to my portfolio, or I could follow on to a company that seems to be doing well in my portfolio. It's just a better decision from an expected value standpoint to invest in the new company. The caveat, of course, is make sure you diversify, right? And that helps you diversify. If you have a rule in your fund that says we don't do follow-on investing, it makes it really easy. You're forced to diversify. And that's one of my favorite concepts from game theory and AI, is this concept of a forcing function. Sometimes it's better to limit your decisions, your possible decisions that you can make, because you'll actually make a better decision in some circumstances.
I want to talk about the follow-on investing piece, because that to me, a couple of things. That to me is very interesting. And number one, I do agree that the VC model is broken. What investor wants to sit for 10 years waiting for their money back? This is one reason why I went and opened an AI fund, because I believe that the AI industry is moving at a breakneck pace. It's ridiculous how fast it's moving. And so because of that, you're going to see exits happening instead of the 7 to 10 year time frame. I think we're going to see exits happening more at a 5 or sub 5 year time frame. So I totally agree. The VC model needs a remodel. But I want to ask, Rafe, so number one, 300 investments. Okay, so is like a micro VC or even a small VC firm, say for example, like mine, we're a $50 million VC firm. We have 2 managing partners. How do you manage that? How do the managing partners keep all of that in between the lanes? Number one. And then number two, as far as follow-on rounds, not doing follow-on rounds. So wouldn't pro rata rights take care of that? Right? You put more money into the company at the same price that you did originally, right? If it's going to be that unicorn type company, because what will happen is, of course, you want non-dilutive rights too, because on future rounds, you don't want to get diluted when you want to have as much of that company as possible if it's going to be a unicorn company. So when future rounds take place, you don't want to get diluted out. So those are my thoughts. 2 questions.
Yep. Cool. I'll just say, if you can get anti-dilution protection, it's all that, then yes, of course, that's an incredible strategic advantage. And in general, what I would say is if you have limited resources, and 50 million, that's limited resources, it really just depends on, again, how confident you are, what the success or failure rate is in terms of your own liquidity. The math shows that if you want to have better risk-adjusted returns and not be gambling, it's better to invest in new companies rather than do the follow-on rights. Except if you have anti-dilution, that's just an unfair advantage. So go ahead and take that. And there's nothing wrong with doing the follow-on, especially if what it means is you're actually really involved. Maybe you're involved at the board level. You're really helping your portfolio companies. I would say most VCs are not really adding a ton of value to the operations and the strategy and the management of the company. And of course, every VC firm is different. So I'm just casting a broad stroke. So I imagine, yeah, if you're really involved and you're adding a lot of value, then yeah, go ahead and put your money also where your advice is and your help is. I'm just talking more generally for the industry as a whole. And then you asked the other part of the question was, how do you actually do this? And this is where AI really comes into play, because I'm sure you're using AI in and experimenting with all sorts of areas of your operations that prior we didn't have this tool. So, for instance, sourcing, diligence, managing the portfolio, the cost and the efficiency of managing a larger portfolio has really come down with the advent of AI tools, and it's just going to become even more powerful, and you're going to get even greater leverage. So, whereas it might have taken a staff of 10 to manage a 300 company portfolio, I think you can do it with 1 or 2 with AI and other automation tools and data sets. So that's a blanket statement that I would make. It will be yet to see, but there are firms that are deploying at scale with a very, very low footprint in terms of staff. You can take a look at the Right Side Capital, which is one of the first Moneyball funds. And they've, how many thousands of companies they've invested in the last 8 or 10 years, and they have a very small staff. So they're able to do it. One of the keys, and here is an important caveat as well. Standard VC takes about 5 months of diligence and negotiation to make their first initial investment. Right side capital and the new school of venture capitalists, they're making yes, no, quick decisions in the course of a day.
Okay.
And so they're just looking for different signals and they're doing different kind of diligence instead of really vetting everything out, total addressable market, timing, idea, business plan, strategy, all that stuff. They're really simplifying and making it high volume. And so that's another key factor if you're going to play this. I call it Moneyball.
Yeah.
Familiar with the movie and the book. And so it's about, and Moneyball, in addition to this high volume quantitative strategy, it's also about not going for unicorns or grand slams. It's about going for singles and doubles.
Yes.
And you mentioned this too. I think you're right that we're going to see, especially with AI, quicker exits. We saw this in the Web 1.0 and the Web 1.0 frenzy. People were getting bought out within months. Now that's not a sustainable thing, but that's the kind of environment that we're in right now. So if you're looking to take advantage, you can expect quicker liquidity profiles. But a long term trend that I see, and I'm curious what you both think, is when you add tokenization and blockchain to the equation, and more traditional startups that used to be normal corporate structures are now on the blockchain, and instead of issuing stock, they're issuing equity tokens. We have the possibility for immediate liquidity.
Yeah.
Think that I think this is an inevitable trend. Not every company is going to provide immediate liquidity, but it really is good to provide a free marketplace for investors, for founders, for early stakeholders. Who wants to be locked up for 10 years?
Absolutely. Not this day and age.
No.
So you have a lot of good points. And I wanted to, before I pass it back to Rohan, I just wanted to mention a couple of things to level off on what you said there. So with the kind of, we're talking about 300 investments, right? Let's say a small firm like mine, I think it can be done. And I like it. So you're looking at roughly 11 to 13 deals a month over a 3-year investment period. I think it can be done. And I like the kind of fire and forget model with the safety of dispersion and diversity in your portfolio. It reminds me of when I was in the Marine Corps. I was a Stinger missile gunner. So I was trained to shoot Stinger missiles and blow up, fighter jets and attack helicopters out of the sky. But it's a shoot, look, and forget model. It's a fire and forget model. And so if you miss
ready, fire, aim.
Yeah. So if you miss your target, you better hope you got some good cover and concealment, because that fighter jet is going to come around and blow the hell out of you. But one way that we remedy that is through overlapping fields of fire and mutual support coverage of different Stinger missile teams over air threat theater. So we all have fire and forget, but we have a lot of teams out there to cover us if we screw up. And that's kind of if we screw up and miss. So that's like the same thing in my mind of investing with dispersion. And through dispersion, you have like mutual coverage through your investments, but it's a fire and forget. And it reduces the laborious nature of kind of running a fund in a lot of ways. But one thing that I want to ask is, does that make the game more competitive for VCs? Because family offices, one reason why family offices and LPs invest in a VC firm is for our fiduciary expertise, but also our expertise as entrepreneurs in that industry. Is this something that a family office or an investment group outside of maybe the AI industry could do on their own? Does it make it more competitive for VCs?
Cool. I'll address that in a sec, but I want to go back to a point. It was a really good point you made, an analogy, and regarding what you're doing by, we call it disbursement strategy. I call it Moneyball. Some people call it spray and pray. I think spray and pray does it a disservice, because really what it is that we're both talking about is having a process and making decisions based on your process rather than gut feel or researching the hell out of something where you're not going to get much signal in the noise. And whatever it is, your process and your decision criteria, I say it's great. Just automate it as much as possible. And then what that enables is that enables you to do the high value human things like supporting your companies, right? So then you can use your talent and your expertise to really help your founders grow. And wouldn't anybody want that to be the case? And so I'll leave that there. Your question about, yes, is it going to be a more competitive landscape? I think of it as a rising tide lifts all boats. Wouldn't it be great if we had 10 times more capital in the venture ecosystem? That's 10 times more capital to venture firms and managers like yourself. And then that's 10 times more capital to the entrepreneurial ecosystem. So, yeah, it will be more difficult for someone who has, let's say, an incumbent structural advantage, but they're not really adding value as a venture capitalist. It's going to be tougher for them to raise their next round.
Makes
But
sense.
for folks who are hungry and are thinking ahead and they're thinking about where they're putting their limited resources, their intellectual capital as a VC, I think you're going to be doing great, relatively speaking.
So,
Wonderful thoughts. I'll pass it to Rohan there.
yeah. So, Rafe, as you're saying this, as a technologist and entrepreneur, clearly I'm building this in my head as you're talking, right? And so my question regarding this is this a concept stage, Moneyball? Are there platforms that are, because it goes back to my original question, which is, why would VCs be more successful when they've already had all the resources and they've not? I don't consider them to be very successful. If you look at any industry and you say that you're doing a 90% failure rate, that's not such a good thing, right? So why is that a good thing in the VC world, right? Just because VCs have all the money in the world, right? And people continue to give them money for that level of failure. So I'm buying into your concept, the Moneyball concept, and I totally get it, and I can see how that's totally logical. You're spreading your risk because of diversification. You're giving a lot more entrepreneurs opportunities for funding their project. You're bringing in a lot more technology and use cases under your umbrella. So, you can still afford to fail, but you're going to have potentially a lot more potential for success. And it's based on automating a process that you believe in. And this is perfect for what AI is good for, right? These are the things that we're building right now. We're building a lot of AI agent stuff and multimodal stuff. We're building all the cool stuff, right? So that's what we're doing. So my question, is there such a technology? I literally have all the pieces to build this like today. I could show up with something next week. I want to know if there's something already out there that delivers this, or is this just a conceptual idea right now?
Great question. Yeah, so it's early stages, but there are a handful of funds like Right Side that are deploying at scale, and they're taking a quantitative Moneyball approach. So there are VCs that are out there in the market. In terms of platforms, the closest thing that is out there, I would say, is the accelerators like 500 Startups, Y Combinator, Techstars, where they're de facto Moneyball funds, and you can invest alongside of them. But I think there's a real opportunity. Maybe we should talk after this. But I would love to see platforms out there that would democratize access to this asset class. Why not for everyday citizens, unaccredited investors as well?
Yeah. No, like all the pieces that you're saying, yeah, let's have a talk, because what you're saying actually makes sense. A lot of the stuff that I hear from VCs makes no sense to me. I think VCs live in a different planet than the rest of the world, and I'll say that, right? I think if you're in Silicon Valley, it all makes sense. If you're out of Silicon Valley, none of it makes sense. Like literally, I would never give you my money in any of those cases, right? For anyone outside of that market, right? It is literally, yeah. So anyway, as an entrepreneur, I'm not an investor, to put it out there. I'm speaking, I think, for a lot of entrepreneurs. But and when you hear about how successful some of these VCs are, well, we've done like these 5 or 10 really big cases. Yeah, but you've lost like 1,000 others. So I'm sorry, dudes, you need to do better because you're taking the dreams and hopes and lives of entrepreneurs. And when an entrepreneur receives investment, they're like, wow, it's done. And I'm going to give up everything in my life for the next period of time because this is a done deal, but it's really not a done deal because I think that VCs could do much, much better. So I put VCs on notice for that. But that's my point of view and opinion. So if there is something that can really help with this, and again, this is the world of AI. AI is the world of opportunities. AI is a world that, hey, this thing was impossible 2 years ago. Guess what? We can do it right now. A lot of things that we build today, a lot of things that I know that we're building and I see that's coming down the pipe are things that would have been, there's things that I wanted to build 10 years ago that was just impractical and impossible to build. And today, with a couple of developers, I can build it in a couple of months, right? So it is a very different landscape, a very different world. I'm coming from the blockchain world as well, so I get the point of tokenizing, whether it's your stocks or options or like basically everything can be tokenized today. And when you start putting together, and I wrote a lot about this stuff a few years ago, coming from being a CTO for a publicly traded blockchain firm and built tons of blockchain stuff in the past. So I can speak about that. Tokenization of ownership in a company would create pretty much instant liquidity if you have the market that you can go ahead and do the selling and the transfer and then the exchanges for those tokens. And if you're doing that in a public market, it's not even limited because this is what exchanges are in the blockchain world. You don't even need to be an accredited investor, right? You're becoming an accredited investor. You need to be an accredited investor, of course, if it's a security, and that's a whole different discussion, right? But the concept of what you're saying regarding tokenization and the ability for AI to create an automated process based on stuff that you believe and to make better, more informed, quantifiable investments. From my side, I think it makes sense.
Cool. Yeah. And you're right about, I see it the same way in terms of there's an inevitability. It makes sense that AI is going to revolutionize the investment process in venture capital in the same way it did on Wall Street when the quantitative trading firms are all using AI and machine learning. It totally changed the way Wall Street worked. Same thing happened in poker, too. Chess fell in 1998, I believe, where the computer beat the world champion human for the first time. But computers are the best poker players now, too. So I think it's inevitable.
Yeah, and I built a company years ago in the FX space, and we changed a lot of that stuff as well because high frequency using different algorithms that human couldn't keep up. And so the entire FX landscape changed, and that was before AI. I'm sure if you go back now, and I'm sure there are other people that's doing that. I'm not really in that world anymore, but I'm sure in that space as well, because now you can do a lot more predictive analysis. You have a lot more access to data, and you can build algorithms pretty straightforward. And now that you're also able to do AI agents to be able to do a lot of the backend research, like all the stuff we're building, we just use AI agents in the backend.
Yeah.
People are like, how did that happen? Yeah. So it's just a very different world technologically, a very different landscape. We'll be able to solve those problems that just trying to even figure out how to do that just 5 years ago was just close to impossible or very difficult. And I know that you're coming from the background of from the beginning, a lot of the things that you were probably aware of cognitive intelligence and cognitive search and stuff, nothing is new about that's been around for a few years that I spent some time in as well. you're seeing that where AI is today, where, 01 or oh 01, whatever we're calling it, for the ability now to be able to, what is the phrase we're using, to basically think, or I'm not thinking of the correct technical terms, but where AIs can now think before they make a decision, right? We can stop them in the process. That's cognitive intelligence, right? So it's not new, but now that you can do it basically on the fly, that's really what's really new. And OpenAI is doing a really good job of that, but there are also other people on the market. So when you start taking all of these things into consideration, literally everything that you just described, it's very doable today technologically.
Yeah. And what excites me is once we've automated the routine and repetitive tasks and analysis that AI is much better suited for, it allows us humans to elevate, just like you do as a software developer, right? You're in charge. You tell it what it is that you're looking for, what your goals are, and then it goes and it automates and it does your bidding. Same thing in venture capital. We're not taking humans out of the loop. We're actually making them more important, and we're increasing humans' capacity to do the things that humans are meant to do.
Yeah.
And frankly, I think it's going to be a good thing for the founders as well of venture capital firms, for instance, they're using AI to make certain investment decisions. Again, it frees up the human VC to really get in there and help the company.
Yeah. Yeah. Sorry, the phrase I was looking for was reasoning. So AI's ability to have reasoning capabilities added to AI agents and now adding to multimodality. When you put all these things together,
Yeah.
we're actually at a very different level than we were even 6 months ago within the AI landscape. And when you put all these things together and the things that we're starting to build with a combination of these things, which is what I spend my daytime doing, then I think people will be shocked as soon as in the next couple of months about the things that you'll see in the market. I know from us and I know from other teams that are building stuff, utilizing these technologies as well.
Yeah, very exciting.
Yeah. How about that, Paul? You're in mute, Paul.
Yeah, no, I've enjoyed this conversation. I didn't really have any other questions for you, Rafe, on my end, other than just if you have any closing thoughts in regards to what we talked about, anything you want to add. But if not, then just tell people where they can get a hold of you if you like. And also, oh, yeah, how they can get a hold of your book as well.
Sure. Yeah. No, and I love having these kind of discussions. So anybody who wants to have this discussion, they can find me. The best place is my website. It's my name, Rafe, Rafe, Furst, FURST.com. That's RAFEFURST.com. And the book will be coming out in the new year. And by going on my website, you'll be able to find it. You'll be able to find it on Amazon as well.
Fantastic. Looking forward to it. Looking forward to reading that book and purchasing it as well. So in closing, I just want to thank you for your time, Rafe. I want to thank my co-host, Rohan, as well. I hope all our listeners enjoyed what we talked about here today. I hope it was insightful for you. And if you'd like to be a guest on Explainable AI, please feel free to reach out to me. You can find me on LinkedIn, Paul Anthony Claxton, or just pick up my contact info from the AI Accelerator Institute website or my personal website, paulclaxton.io. Rohan, before we close, any closing thoughts for yourself?
Yeah, this is a really cool conversation. I am a fan of Moneyball already. So if someone doesn't build in it, we're going to probably build it next year whenever I have some time. I'm slammed right now. We're releasing a new technology, OCESHA.com, to help with leveraging, it's basically content creation, distribution, and monetization for entrepreneurs. So it's actually something really cool. So we're releasing that in about a week or so. People can find more about me, rohanhall.com. That's Rohan, ROHAN, Hall, HALL.com. Or like I said, OCESHA.com is your new stuff where it's not on right now, but by the time we drop this, it'll be out there. We'll release that in December sometime. And thanks again, Raf. It's been fantastic. I really like your ideas, and I think that there's a lot of validity, and not just from an investor VC point of view. I think from an entrepreneur, because we got to look out for the little guys. It's the little guys. These are the guys that are spending all their time building these things with the hope of making a better life for themselves and their families. And we don't really hear about all the failures as well. We focus on just there are only a few of these, the Bill Gates and the Zuckerbergs, and these are fantastic, amazing geniuses guys. But the entrepreneur landscape are filled with a lot more people. So thank you. I hope this would be helpful for everyone as well.
Thank you both for having me on. This was a really fun discussion.
Absolutely. Thank you. Bye-bye.
All right. Thanks, guys.